talked about that we're going to go into the lab and run multiple scenarios in order to find those wealth transfers and to ultimately help you figure out which financial strategy makes the most sense. So again, this is one of multiple software programs that we use. This one's called Income Solver. So this is a sample case that we put together, but I'm just going to show you how this works so you can kind of see the process that we go through. So here's the household details. We've got spouse A, spouse B. We put in their dates of birth right there. And then we also input their assets. So we've got 175,000 in a brokerage account. We got some savings. We got 401ks, and we add up to about $1.5 million. Now, what we also see in cash flows too is that they're going to work for another couple of years. They need about $12,500 net after tax to live on to maintain their current standard of living. So here are their current incomes. They're going to work for another 2 years. And in this scenario, we're going to assume that they have no pensions or annuities. Okay, so they're going to have Social Security and pull the rest out of their portfolio to maintain their standard of living. Okay, so one of the first things that we have to determine within our retirement planning is what is our Social Security distribution strategy? We call it Social Security optimization. Okay. So what we have right here is that we take the Social Security amount from their statement, and so this is a hypothetical $3,000 a month for spouse A. We're going to have Medicare start at 65, and we also have $2,300 a month for Social Security for spouse B. Now that's what we assume at their full retirement age. Okay. Now we're good there. So let's kind of go to the Social Security section. So this is the Social Security Analyzer, and it's very, very in depth. So we can compare and contrast various strategies. Okay, we can look at, so if you feel like you have a shorter long lifespan versus an average or a long, we can compare and contrast various strategies. Okay, so let's kind of compare different strategies. Let's compare, let's say you file at your full retirement age, and then we want to compare that to delayed. Okay, so let's kind of compare those. All right, so you can see the full retirement age is here in yellow versus delayed. So you can kind of see over normal life expectancy, delaying the Social Security is going to provide more income of your life expectancy, especially if you live long, for a long life expectancy. So you can compare and contrast. This is when spouse A takes benefits, and then here's when spouse B takes benefits, and you can add it up. You can see what it is, and you can also see here's the cumulative benefits. So you can see right here, around 82 or so is sort of the infamous break-even point. So when does it make sense to delay, and how old do you have to be for that to make sense? So we can compare and contrast various Social Security strategies right here. Okay. We can also take you to the SS zone, which I like a lot. And so, but basically what this is showing you is that if you have a short life expectancy here in the red, it's sort of a full age retirement, and also sort of a longer life expectancy in terms of longevity expectations. So what this is showing you right here is that if you live to your average life expectancy of roughly age 85, that's the green section right there. And you can see that there's no question that delaying your Social Security to 70 is a better approach if you feel like you have an average life expectancy. But if you don't believe that, then we can play with that. We can do different things. We can have the client dies at 75 and the spouse dies at 80. We can do all sorts of things. We can move things around. Okay, so we can do all these hypothetical scenarios to kind of see, well, what if? And that's the whole point of this. It's the software that we use to do these what if scenarios. We can compare and contrast. Okay, so ultimately, you can look at the summary right here, and you can see in this case is that we kind of recommend spouse A defer Social Security to age 70. And again, you can see here's how much you'd receive for a short lifetime, a normal or a longer lifespan. Then spouse B begins her benefits also at 70 as well. Now, if you want to change that around and maybe have spouse B started at the full retirement age versus 70, again, we can compare and contrast that and have various numbers. But you can see here's if you take Social Security early at your full retirement age, if you delayed, and we can do all sorts of combinations in between. So this is the first thing that you want to determine is your when to file for Social Security. Okay, so that's the foundation, and we kind of build from there. So now we look at the various strategies, and so we're going to look at various strategy ideas, and this is what the software kind of looks at. So we have the most popular strategies that advisors kind of use in this software we'll use right here. Then we also have a standard list of distribution strategies that are commonly used in alternative software. So there's lots of different financial planning software out there. And so we're going to kind of compare and contrast. Now, essentially what this is doing, if we scroll down a little bit more, there are about 125 different scenarios that the software has to kind of work through, and we ultimately can kind of sift through this and kind of fine tune what we're looking for. So we actually had a save scenario up here. So I'm going to go to our save strategies. Again, I'm going to try to keep this video reasonably short, but I could go on for an hour, but I'm going to keep it short because there's so much stuff to cover. Okay, so we're going to go to the strategy overview. In this strategy, what we want to do is we want to see, okay, if we did Roth conversions, if we retire, we do a Roth conversion, pay the tax, and put that into a Roth IRA, what would that look like? So we can compare and contrast these things. So we're going to analyze the strategy. And the first thing I want to do is I want to compare details. So let's kind of compare that to a base scenario, which is basically not doing Roth conversions, but we're just going to kind of continue the course and take a required minimum distributions as many people do. So you can see in the base scenario right here that, right around 83, 84, that's where the guide path really starts to fall off. And you can see that the value of the portfolio is really dropping off because as time goes on, hopefully we have bull markets and the portfolio, the qualified plans continue to grow, but also as the 401ks continue to grow in retirement, so do the required minimum distributions. That's a bigger tax hit that we have to take. So you can see right here a comparison between the required minimum distributions here on the right. You can see that the base case is paying a lot more money in required minimum distributions. I mean, look at that, it's $104,000. 109, 113. So again, this is kind of based on the inputs that we kind of entered into the software, but you can see with the other strategy, doing the Roth conversions, is that, yeah, we're going to pay a little more tax in the beginning, but our overall taxes are much lower over time. So you can see also the total taxes. Yeah, we're going to pay more taxes up front, but our taxes as we age are going to be considerably lower in this strategy here. And so you can kind of see, compare and contrast the differences. So it's really kind of interesting to kind of see, where things really start to kind of break even right here. So if you look at the after-tax balance of the portfolio, you can kind of see right around here, 82, 83. Is that you kind of see that that's where the conversions really start to come into play. So you can see the net after-tax balance in the portfolio is about 2 million and about 2 million, pretty close. But you could also see that the amount of Social Security here in our recommended plan is about $113,000 a year compared to 86. The total taxes that we're paying at 83 is just under 13,000, where on the base scenario they're paying 44,000 in taxes. And you can also see the before tax balance is a little less, but you can see the after tax balance is about the same in terms of break even. So every year beyond 83 in this scenario, we can see that the Roth conversion strategy is just more advantageous. I mean, if you go to the end of the plan right here at age 99, you received, who knows if we're going to live to 99, but over that course, you received over $3 million in Social Security versus 2.6. The amount of, you look at the columns right here, the total taxes paid, about 829,000 versus about 1.5. And the amount of money left in the portfolio at the end of the plan at age 100 is about 1.2 million versus 181,000. Okay. So what I just wanted to kind of illustrate in this one tab is that we can compare and contrast the various strategies. Okay. And so the only way you can effectively do true financial planning is to go through this process and take a base case scenario, and then we can compare and contrast various solutions. So this was a very short kind of demonstration of what this can do. But again, here's the Social Security. We kind of showed you the Social Security report right here, so we can have the details. We can compare the various strategies, compare to earliest, compare to delayed, compared to full retirement age, so we can compare and contrast these. But it also, what's nice is that in terms of the withdrawal plan, you can see over time which accounts to pull from and what year. So you can see right here in the yellow, we're taking not requirement distributions, but we're actually taking distributions from qualified plans to do those Roth conversions. We're doing that early. So we're trying to get that done before age 73 or age 75, depending on how old you are. And that's when the requirement of distributions start. So we're front loading those distributions to ultimately save lots of tax down the road. And you can kind of see here's the RMDs right here. The withdrawal rates, you can see that we're withdrawing a little bit more in the beginning to offset taxes down the road again. So we're offsetting, we're taking more out to do those conversions early. And you can also see the withdrawal plan schedule. Now, obviously, your situation is going to be different. And one thing I was going to point out, so what this is recommending is to really take out a lot of money for these years right here to do conversions. Well, what if you don't want to do that? Well, we could actually limit how much that you want to take out in the software. So if you want to get that down, one of the things that you want to consider is when you're doing Roth conversions, okay, that affects, remember that's ordinary income, and that affects your Medicare premiums. So one of the thresholds this year is $194,000. So if you get above that, then your Medicare premiums will go up. And maybe you don't want that to happen, okay? So we can really go in there and kind of fine tune these numbers and really kind of hone in on a strategy that makes the most sense for you. So you can see, and right here, here's the withdrawal schedule. We're taking all this money out for conversions, but we still have some money that we're taking out of qualified plans, but we also have some Roth IRA money over here, okay? So this was just a very, very quick overview of what this software can do. Again, we're just scratching the surface, but the main point I want to make is that when you hire us to do financial planning, this is what this is what you're paying for, okay? Again, we've got all the clubs in the bag to help implement things, but you've got to go through this process. And what we're trying to do is we're trying to identify those wealth transfers so we can redirect that money back to you so you can determine how to best spend that money. Are you going to spend it on lifestyle? Are you going to put it towards protection? Maybe have a better strategy to deal with rising healthcare costs down the road? Or would you rather have that money to go to your family in terms of leaving a larger legacy? Okay, you guys are driving the boat with this, but ultimately this is one of multiple tools that we use with our clients to help make those decisions and to create that ideal roadmap. And the other thing is that when you are a client of ours, is that we do reviews at least on an annual basis. So every year we update these numbers and make sure that you're on track, and if we have to make any adjustments along the way. Okay. So anyway, I thank you for watching part 2 of the Financial Lab. So we look forward to talking to you soon.